very good evening and a warm welcome to Personal Finance. I'm Guguletu Cele. Now, certain circumstances can dictate the need for a joint bond. But what happens when a partnership breaks down or death occurs in a marriage? Stephen Barker, Head of Home Loans at Standard Bank, joins me now for a look at whether joint bonds are forever or can be adjusted. Good to have you with us this evening, Stephen. Let's start off by taking a look at joint bonds. When and are they ever necessary?
I think generally absolutely necessary, and you see most people, that's a common way that they can actually afford to buy the property that they wish to buy.
Let's touch on the joint bond situation. Does it necessarily apply to couples who are intending on getting married, those who are cohabitating, or just individuals who want some kind of partnership between themselves?
So I think you see joint bonds being used in many different places and for different situations. So most commonly it would be between people that are married, that are going to own a property or own probably their biggest asset in life jointly, and hence they put the liability or the loan for that in the joint names. I suppose too, you do find situations where people take out joint applications where it's not necessarily under marriage to help them afford property that they wish. And that could be a wide spectrum, all the way from people getting involved in an investment property to sort of two people deciding outside of marriage to own a property together.
Let's focus on the marriage implications for the moment. What are the key considerations to take into account? Are there legal implications to having a joint bond together?
So I think generally more the common way of owning, and with the particular purchase, obviously it helps up front with the purchase power of two individuals, which really doesn't only sort of focus to marriage. I suppose the piece when you look at it from a marriage perspective, there are some broader protections in law, but what people would generally do is getting into the house is not the particular challenge. It sits in a situation where something occurs in the matter of divorce, and now all of a sudden, this has to be unwound within conditions that people have to mutually agree.
Does this always go back to the kind of marriage contract that you're in, antenuptial or joint estate?
I think it does, but it's obviously a lot broader, the particular question. And I think, where you've got people that can understand how they wish to, sort of what the agreement's going to be, who's going to keep the property, if there's any debt, who's going to take over that debt, generally that would work. But where there's not agreement, can get a bit sticky.
So if we're in that kind of situation where we're not even tolerant of each other and don't even want to see each other, how do we find a resolution when it comes to dealing with our joint bond? First step is obviously approach the bank, but then?
So I think with that, a large piece of it is the bank most certainly finds it a lot easier, and probably the only real place for the bank to get involved is when there is an agreement of how this is going to go forward. So that might mean potentially getting the lawyers involved to figure out what this agreement is. But then once we sort of understand what the wishes are of both the particular parties, the bank could sort of then figure out how they assist within that particular agreement.
Would that be referred to as substitution then?
It could very well be. So you could find a situation where, I suppose the one scenario is to sort of say, well, let's just sell this house, and both people then effectively benefit from the proceeds of that sale and move on. In other situations, it might work that one party wants to retain, and then when we've got outstanding liability or that loan on that particular property, the bank would have to go through a process of figuring out whether the person that's remaining can afford that bond, and ultimately they become the substitution on the loan, but also they become the full owner of the property.
What about the concept of surety, Stephen, especially in the case where one partner is not able to pay?
So I think it's a possibility. Generally, we exercise quite a lot of caution as banks when entering into a surety type agreement. But if we take the example where there's a situation where one spouse effectively can't afford that property on their own, there's perhaps two scenarios to it. So one is the existing partner or the partner that's exiting the particular property would then sort of stand surety so that the bank could get comfort that the debt could be served. Also too, the bank would look to substitute the maintenance payments, if there are any, as an actual income in our affordability approaches when assessing that.
Maintenance of the spouse or the property?
So maintenance in terms of paying, in terms of marital maintenance or maintenance that comes out of the divorce proceedings versus not particularly property maintenance.
Like alimony.
Alimony.
Okay, that makes sense. Now, let's touch on the area of insurance, because that's a hotly debated one. And does it depend on, does the insurance cover both the joint policy holders or an individual who might earn more income, or what are the nitty-gritties with regard to that?
So I think the way we'd look at it, and just for clarity, there sometimes can be confusion when coming to a home loan. There are generally two types of insurance. So one that actually protects the bricks and mortar, and that's the old, most often we claim on for a geyser, but also for fire damage and all the rest. But specifically where we're talking about here is more life type insurance policy, which would cover people. So if, as a bank, we would take out in terms of a joint bond, we would generally look for joint life cover that could cover either parties for the full outstanding if anything does go wrong in the event of death.
Mm-hmm. In that particular scenario, are there any worst case situations where you've seen maybe the insurance cover isn't sufficient, or how often does that also need to be reviewed? And how closely is the bank involved in issuing that kind of insurance?
So I think the insurance, particularly on the life insurance side, it's a firm requirement when people take out home loans. But as you sort of say, through time, people sort of have those policies lapse or don't take them out. Generally, I don't think we necessarily deal with people being short covered, because most of the time people maintain those particular covers. It's more the situation where there is no life cover at the point of the event of death. So that is sort of more problematic. That then would revert into a situation where the surviving spouse cannot afford the property on their own out of particular income. The only option would then be to actually sell the house to get out of that sort of loan commitment.
Let's talk about further about the incident in death. Are there any common issues where you've discovered that maybe there isn't any homeowners insurance to ensure that the property will be paid up in the case of death? What options does the surviving spouse have available to them then?
Yeah. So I think it is that the first cover is absolutely focus on the life insurance cover. I think that helps, and that does give you sort of a lot of peace of mind, and will also make the whole process in the event of death a lot smoother. You can get life policies that are directly linked to the particular loan, which just make the whole estate planning and the unwinding of that particular, the winding up of that estate a lot easier. But failing that, if there is no particular cover, then largely what you do is you're reverting back to surviving spouse ability to pay the debt. And if that's fine, the person's able to pay it and they can be granted the home loan on their own, you then don't have a problem. Failing that, I think the only real alternative to that then sits in a situation where you actually look to sell the property to settle the debt.
Tough calls that people need to make, quite clearly. We've touched on a few scenarios, but now time for us to touch on even more and to apply what we've learned in real life scenarios. Well, Stephen, let's apply some of the knowledge that you've imparted on us by dipping into our case study jar for the first real life scenario. Well, the first question reads, I have a joint bond with my husband for our home. Does this restrict me from having a joint bond with my sibling, where the property will be used as an investment vehicle for rental income?
Okay, so besides first asking for a redraw, which I think, that's probably the more sort of complex, where people need to sort of exercise caution. So quite often a property owned with a spouse, with a partner, and acts as the particular primary residence, that is generally people's first priority. So the question here is really about sort of saying, does it stop me from getting into another bond with potentially another family member? And the answer to that is absolutely possible. It'll depend on the person's capacity to take on further credit, as well as their affordability around that particular loan. And so I think absolutely possible. In the scenario of an investment case, I would actually urge people to do a little bit more sort of forward thinking around the situation of, so what happens if this investment doesn't turn out? What happens if we have to put more money in than we expected? What will be the arrangement in this sort of situation if things don't work out? And
contracts are important there, because you do it from a business perspective, but when it's with your sibling, I take it you shouldn't be as relaxed either.
I think people need to be careful, because I think the idea is, it sounds like a great idea until it's wrong. And the one thing with owning property, it can be an absolute great investment, but it does need things like property maintenance, which means that the bills can sort of ratchet up. So if that rental income's not coming in, there's an additional bit of maintenance. It could add pressure to what seemed like a great idea up front. So I guess the key thing is, absolutely you could do it, but particularly in that sort of scenario, outside of a primary residence, I would sort of exercise a little bit more caution and also think through, what would it mean if this doesn't work out, and what would our exit strategy be?
Exactly. Well, it does seem as though we've run out of time to go for a redraw, but very quickly, key takeaway points from you for this evening?
I think if we look at it, it's not a matter of joint ownership, yes or no. I think joint ownership is a great concept, allows people to buy through. But I think with it is, when you sit within a particular situation, is how does one understand the most appropriate way to get out of it? So yes, it might need legal advice, but two, the quicker people can get to some sort of mutual agreement, and that mutual agreement can be acted from themselves, as well as the banks aligning the debt to that, the sort of more likely the better the outcome is for everybody involved. So it's more just almost take your medicine when situations happen, get to that agreement and move on.
Get to the agreement. Stephen, thank you so much for your time this evening. Well, that's it for Personal Finance tonight. A big thank you once more to Stephen Barker, Head of Home Loans at Standard Bank. Now, do remember that we'd love to hear from you, so you can tweet any of your comments to @CNBC Africa using the hashtag Finance410, or to myself @Kukumfupi on Twitter. Until next time, it's goodbye for now.